Today I'm going to come up with the analysis of the volume and analyzing that what is the resistance point based on the volume of the trades for a special, stock. And I'm considering SPCE for my analysis today. And the thing is that, we believe that the resistance and support points happen at the points that we have the most volumes of the trades. So as you see here is the distribution of the volume and price of the stock, and here is exactly showing that in these points that we are having some kind of edges. We have more volume compared to different places. So it means that this is a trigger for maybe many of the algorithms or many of the people who are trading. And when this happens, a lot of buyers and sellers work on the market, and it leads to formation of some kind of, in fact, resistance or support. So I'm going to check the resistance and support. And as you see here, for example, in this area and in this specific date at the prices like 10.07, this is a resistance point for my stock. Also, I go and check, a little down. I see that, another resistance point is at the point of 9.75, and if I double check it with my analysis in the curves, with the curves analysis in the trading view, I see that these are exactly the points that I've already selected for my resistance and supports. So the next question of mine is that, how should I know exactly that what would be the next movement of the stock? Another point that we should take care of is the spread. A spread is in fact the difference between the bid and ask price. And the bid and ask price are in fact showing us the supply and demand on the market. So let me go and give you a detailed analysis of the spread, and we can see exactly that what we mean. Here you can see that the price, the in fact yellow line is the implied volume ask, and implied volume bid is the green line. So whenever we see that there is a huge gap between the volume asked and volume for in fact bid, it means that there is a difference in the supply, and it leads to an instability. So in this area that we see that everybody's happy, the bid and the sell are in the same level, it means that the price trend will be the same. So as you see here, the price trend is the same and nothing changes. But whenever there is a gap, in between the spread, the bid and buy spread, we will see an uncertainty. We will see a change. Let me explain you more. Here, for example, is a point that the people who are going to sell are asking higher amount of money than the people who are going to buy, and this spread is the difference between the buy and sell, the difference between the supply and demand. And what we see, one of the sides should accept either the price should go higher or the price should go lower. And it all depends on the blocks and the size of the blocks that will be traded in this point. I will explain you here about the size of the block of the trades. The block of money is showing me something very interesting. It's showing that how happy are the people and how good the trades are going to happen. So as you see here, for example, at 6 p.m. 18 my time, a huge block of money got imported into the market, and as you see, initially it led to an increase into the price, but after a period of time it led to decrease in the price of the market. So let's go and see that what happened exactly at 16 in our chart. So at 16 we see that here 16, there were a lot of trades. The people, the volume of the trades, the volume of the ask and the volume of the bid, we were around in the same direction. Everybody was happy with what is going to happen, and the price reduction was predictable up to some point. And this point is the point that there is a difference. The sellers, which is the yellow line, tell that, we are not going to sell anymore. And the buyers are telling that we are not going to buy with the price that you are offering, so it will lead to an increase in the price. So in any place that we have an upward trend in the yellow line, and we have a downward trend in the graph in the implied volume bid, we are going to observe an increase in the price of the stock. So that is one point. Another point, for example, is here as you see, this is exactly reverse. The Here is the sellers are going to, in fact, let me see, here it is the bid. We are going to buy, we are going to sell at this price, we are going to buy at this price, and there is a difference between these two. So you see here the approximate width or the spread is the same, so nothing special is going to happen. Nothing special is going to happen, and everybody is happy with what is happening. But let's see here. Here, there is a jump in the request. They are telling that we are not going to sell at this price. They are not going to buy at this price, and in here, this bubble is showing some change in the trend and some kind of instability in the market. So this is the other point that I wanted to have in my mind. So based on the things that I understood, so if I want to have a trade in each day, I have to start with practically checking that what were the blocks. First of all, I have to double check the resistance with the volumes, with the volume distribution. The second is that I have to check exactly what were the blocks of the cells and how much was the volume of the cells from the price point of view. And the third, I have to check the spread. And the spreads are showing me if it's a good point to enter or it's not a good point to enter.